Hello and welcome to our special coverage of the credit policy right here on ET Now. I'm Arvan Dabash. Of course, over the next half hour or so, we will be having a slew of guests who will be joining in to discuss what is likely expected from the Reserve Bank of India. Which way will this pendulum swing and what is on the Reserve Bank of India's mind? We'll know. So let's get on board our guests for today. We've got Abid Barua, Chief Economist, HDFC Bank. Taimur Baig, economist at Deutsche Bank, there's Sajid Chinoy, India economist at JP Morgan, Mr. Divarkar Gupta, Managing Director and CFO, State Bank of India, Rajiv Anand, Managing Director and CEO, Axis AMC, as well as Shanti Ekambaram, President, Wholesale Banking at Kotak Mahindra Bank, for our special coverage of the RBI's first quarter policy review.
But this time around, Reserve Bank of India has done a great job of communicating and drumming expectations down. Reserve Bank of India has maintained that inflation is high, monsoon progress is poor, the fiscal discipline from center has kicked in, so don't expect anything big from Reserve Bank of India. But George, with RBI, you never know. Last time they disappointed us. Do you think this time they could surprise us?
If you go by what we had put out yesterday by the Reserve Bank of India, that's the macroeconomic review for the first quarter, it did clearly indicate that it isn't going to do anything anymore until it sees some sort of credible action coming out from the center. You need to remember that the Reserve Bank of India has already cut the cash reserve ratio by as much as 125 basis points. So that's the equivalent of something like 80,000 crores having been returned into the banking system. They've also cut the repo rate by half percentage point, which happened in April. Now, all of this was done, and post this, the RBI clearly stated that they've done their part. Now, they need to see clear and credible action and a roadmap of sorts from the center in terms of addressing issues like subsidies, addressing issues like supply bottlenecks, which in large part is playing up with the inflation numbers. You've seen nothing done on the part of the government. This whole issue of addressing subsidies and fuel prices especially has become a moving goalpost of sorts. So you had the government say as early as February that they would look into it. Many months have passed, something like 4 to 5 months have passed since then. Nothing's happened on that front. So to expect the RBI to push ahead with monetary policy in the hope that that's going to support growth, I think is a little too much to expect from the central bank. The RBI has clearly stated that you need to see action from the center by way of physical infrastructure build out, which in large part can aid growth in a non-inflationary manner. So and at a time when inflation is holding up so high, to push ahead with monetary policy easing is only going to be counterproductive. So I think it's quite safe to assume that you aren't going to see anything today, but there's always been the element of surprise in the past, so you never know.
You never know. Many thanks, George, for giving us that heads up as to what we can expect. Let's bring on board our guests then on the show. We've got with us Taimur Baig, Abid Barua. We've also got Mr. Divarkar Gupta as well as Abraham Chako to kickstart the discussion. Mr. Gupta, I'm going to start off with you. Last time, as Nikuj pointed out, the RBI disappointed. If we go by any indication of what the RBI governor has hinted, this time it's likely to be a non-event. What's your view on the same?
No, I think to the statement of RBI disappointing last time, I think it is expectation that builds up disappointment. On the ground, there was really nothing to expect very much from RBI last time round. Nothing much has changed this time either, because I think the statements of the governor are very clear, the numbers are very clear, and a lot of action lies in improving sentiment and improving overall viability. The surprise element which everybody is talking about can never be discounted. So there can always be the reverse argument that high interest rates are hurting asset quality, and maybe they will not make so much of a difference to inflation even if they were brought down. So we have a small chance of a minor relief, but I don't expect it personally.
Abraham, my mind says that this time around Reserve Bank of India will maintain a status quo, but my heart wants a rate cut. So which way do you think Reserve Bank of India will lean today, growth or inflation?
Is that for me, Chako?
That's right.
Yeah, hi. No, I think it's going to be inflation. I think they'll wait another quarter before they take action on the rates, because again, it's sentiment. At the moment, the industry wants it, the economists say no, and I'll go with the economists that there's no change.
Mr. Gupta, what do you think the Reserve Bank of India can do to kickstart a growth/investment cycle?
No, in the realm of monetary policy, there is only that much that the regulator can do. We have a problem today of a slowing global economy and no demand internally. And the demand that is not, the lack of demand internally has a lot to do with policy and regulation. So really monetary policy cannot, they can cut down rates and risk inflation, in which case all the short-term gains will go away. So I think better safe than sorry is what the regulator is pitching for, rightly so.
Indeed, that's pretty interesting perspective. Let's also get in Taimur Beg. Taimur, wanted to know what's your view on your inflationary expectations for FY13 and what's your observation of the impact of the high interest rates on the demand side inflation as well as supply side information. How do you think high inflation can be tackled over the next 1 year?
Yeah, this is a question that has vexed the central bank for the last few years, that how much of a role does the interest rate play in anchoring inflation expectations, and what is the transmission mechanism from interest rates to inflation? And I think the answer is that given that India is a supply-constrained economy, you probably won't see that much of an impact on inflation if supply conditions remain adverse, no matter how high the rates were. But at the same time, the central bank needs to play on people's expectations, and by maintaining a tight monetary stance, the best that it can do is anchor people's expectations, and that's where I think the RBI is trying to get some bang for its buck. So yes, inflation is high, but at the same time growth is low, but that doesn't necessarily mean that there is a conflict. The clear objective of the RBI to stabilize inflation, and we're not quite there yet, and therefore the central bank needs to remain on the sideline.
Taimur, just a follow-up question from where you left. If Reserve Bank of India today does not cut rates, do you think that will derail the India story?
I think, and I think I'm not alone in this issue, is that the level of interest rate is definitely not the main reason why growth is slow in India. There are many structural impediments, there are regulatory issues, there are policy issues. Interest rate is one of the minor components. India is a fast-growing economy. The rate of return on investments should be sufficient to compensate for zero or slightly negative real interest rate, which is really the prevailing interest rate in India. So let's not get confused by the nominal rate, which is high, but if you take into account the inflation rate, what we find out is the rate of interest is not particularly high. So the answer to that question is I don't think interest rate would be an impediment. And if investment in GDP declines going forward, there will be many more substantive factors what drives that, not necessarily interest rates.
Well, that's all, Taimur. Let's also bring on board Sajid Chinoy, India economist at JP Morgan, who now joins in live on the show. Sajid, if we talk about the Reserve Bank of India governor's indications on, speaking about the levels of inflation, the fiscal deficit, current account deficit, it is all likelihood that it's going to be a non-event. What's your sense?
I agree with that. I think the RBI had very clearly laid out what the criteria would be for any further monetary easing in the June review. And the criteria was simple. They wanted headline, both wholesale and retail inflation to come down to more acceptable levels. They wanted there to be some progress on fiscal consolidation, both in terms of reducing the distortion on oil subsidies, as well as reorientation from subsidies towards capital expenditure. And they wanted to get a handle on inflationary expectations. As it turns out, over the last 6 weeks, I think none of these criteria have been met. I think inflation levels are still unacceptably high, and more worryingly, the risks, I think, are to the upside. We have now a sort of resigned to a subpar monsoon, which is going to put pressure on food prices, but also directly put pressure on rural wages because of the indexation that's happened on Manrega wages. We know that in rupee terms, global commodity prices and crude prices are now almost 10% higher than they were 6 weeks ago. So none of this would give comfort to the central bank that inflation pressures are at acceptable levels. And so I think they're going to stick to their guns and lob the ball back into the government's court.
Let me just set the tone for the markets. Now the bank index or the bank Nifty is down by 92 points, but most of the mid-tier and large PSU banks have taken a knock, anywhere in the range of about 8 to 10% in last 5 trading sessions. So this time around, markets are not charged up in the run-up to the credit policy. In the near term, it's all about expectation management. So if we get a status quo indication from Reserve Bank of India, that will not disturb the market. But any positive communication for sure could lead to a major short covering. Mr. Gupta, this question is coming your way. Now, the chairman of State Bank of India, Mr. Chaudhary, Mr. Gupta, he's gone on record and he's made a case that this time around there is an urgent need for a CRR cut. Why do you think he's making that case?
Look, the CRR cut is a wish list for banks. CRR reductions...
Banks always want that.
Banks always want it because it really adds to their bottom line. And in a hard scenario where credit growth is not as good as it could be, and that too in the segments where we have margins. Anything to shore up the bottom line is great. So a CRR cut is obviously something which has the biggest bang for the buck for banks. But liquidity is comfortable in the system today.
Let's also bring on board Rajiv Anand, Managing Director and CEO at Axis AMC, who joins in on the show. Rajiv, you know, in the last 12 policies, 4 out of 12 of them sprang a surprise, and the last 2 also before that did see a bit of a surprise, and that seriously seems to be driving a hope, though the view is split right in the middle. Which side would you veer toward?
I think we certainly like to see a surprise, but I think the fundamentals really don't justify a cut at this point in time. I think you have a situation where, as RBI has said yesterday, growth is weak, but on the other side we have a problem with the fisc and we have a problem with inflation. So I think clearly, like the RBI mentioned in the last credit policy, the ball is really in the government's court to be able to manage the fisc, improve the investment spend, and address some of the supply side issues that we have today, such that we are able to address the longer term sticky inflationary considerations.
All right, so no action from the Reserve Bank of India as expected. You've got the key policy rates, that's the repo rate, the reverse repo rate, left untouched, so they stay where they are at 8% and 7% respectively. What the Reserve Bank of India has done is that it's lowered the SLR level from 24% to 23%, which essentially means that it just frees up something like 62,000 crores to the banking system for them to on-lend to borrowers. Now, whether or not that is going to have any big effect really on
Okay, that's the word coming in from the Reserve Bank of India. George Cherian, our banking editor who is sitting there, seems to have confirmed for us that the reverse as well as the repo rate this time around has remained unchanged. And that's largely, as Nikunj pointed out, what had been factored into the markets. And if at all there would have been a surprise, then you would have seen a rally for the markets. But let's just get in, Mr. Gupta. No real confirmation, but what is your view on the same?
No, as we had been discussing just before the announcement, it was very, very likely that nothing would have been touched. And that is what has happened on the rates. The SLR cut obviously brings in more liquidity, so people who have been asking for liquidity have got it.
So 1% cut in SLR, what will that do the banking system, Mr. Gupta?
That brings in about 1% of the overall deposits, about 62,000 crores.
This will help your bottom line as well?
Well, the SLR cut does not affect the bottom line so much, because in any case SLR securities earn you 7 to 8%.
Okay.
And you will deploy it at 11%, so the marginal is only 3%.
Okay.
That is where the CRR is great, because the entire 11 comes to the bottom line.
Okay, so the news is, George Cherian, it is status quo.
All right, so there's been some confusion about the embargo for the announcement, but it's okay to speak now. So what we have really is those key policy rates being left untouched, like I just mentioned. The SLR being lowered from 24% to 23%, essentially meaning that you've got something like 62,000 crores, as I just mentioned, available to the banking system to